Enough is enough. Let's finally talk about interest rates, how they affect us, how they affect mortgage rates anyway, how they affect real estate anyway, why are they so important, what do they even mean? We're going to break it all down right in a second. Grab a cup of coffee, see you in a bit.
You're my lucky strike. Love the way you ride. Look into my eyes, say you're ready to go.
Hello, I am Connor Mangan, sales representative here in Toronto. Make sure you like and subscribe in this video, follow me, share it, do whatever you need to. Today we're talking about interest rates and how they actually affect houses, how they actually affect the real estate market. So first of all, an interest rate is the rate that a bank, so in Canada, the Bank of Canada sets a certain interest rate that it will charge. This is based on many factors such as inflation, as we've all come to know very, very well over the last few years. It's based on economic outlooks. It's based on employment jobs, numbers. They go across a whole pile of factors and decide that, this interest rate is right. Interest rates are applied to a bunch of different ways that we earn money and loan money, etc., etc. So for the purpose of this video, we're going to focus on mortgages and mortgage payments. Okay, at the end of October 2023, it stayed at 5%. People worried that it might raise it, but they didn't. They stayed at 5%. So what does that mean? What the hell does 5% interest rate mean? I have no idea. I'll tell you what it means. It basically means they set it at 5%, so banks can actually loan you money kind of it gives them a guideline of where to loan them money. So the best rates right now, kind of coming from Scotiabank, it will vary on your income. It will vary on your credit, kind of different factors that affect how much of a risk you are to the bank. So best sort of rates probably in between the kind of 5.9 to the 6.3 range, depending what type of bank you're with. That's called your prime rate. Your prime rate is the best possible rate that a bank will give you for their best clients. So people with great credit, steady jobs, etc., etc. And how they're actually calculated is usually by an amortized schedule. So that sounds like complete hoo-ha and blue to half of you, but that's okay. An amortized schedule, I'm going to explain it, is basically how you structure your loan over a certain period of time. And it's basically they make you pay a lot more interest at the beginning of the loan than principal. And then as you progress through the loan over the time period, your principal payment goes up and your interest rate payment goes down. So what does that actually mean? Well, I'll show you right now. This is our mortgage calculator here. The one I like to do is let me make that smaller so you can see. This is mortgagecalculator.org. And we're looking at a basic price here. So we're going to put in about a rate I just saw from Scotiabank is 6.35%. Okay, so home value about 500,000, okay, $500,000. Let's say I put a down payment of 50 grand, which would be 10%. Okay, to avoid CMHC insurance, which is another topic altogether, you have to put down 20% in Canada usually, but we're just going to put down 10% being the average. So your loan amount, your total, your actual mortgage is going to be 450. We're going to pick this interest rate because I just saw it on Scotiabank. Loan term. Now, why is my loan term 25 years? This is kind of the average in Canada, 25 or 30 years mortgages. So that means if I bought a house and closed on it tomorrow, I would have paid off this loan in 25 years. So we're going to calculate a mortgage of $450,000. And I'm going to pay it off in 25 years, and it's amortized over 25 years. So what I just said there, amortized meaning I pay more interest at the beginning of the loan period than principal, and then towards the end of the period, I pay more principal than interest. And I'm going to show you exactly what that means. So I've gotten rid of the rest of the stuff here because they actually won't affect your mortgage payment. They'll affect how much you pay per month, but everybody's situation is different. If it's a condo, you have to pay HOA fees. You got to pay property taxes. If it's a home, you might have just general maintenance on it. You might have lawn maintenance. You might have different types of taxes. You might there's a bunch of types of things. We're leaving out all those numbers. We're just focusing on our loan amount. We're going to calculate it. Boom. This is how we get our amortized schedule. So see, we're at 2023 right here, the end of 2023. This is November 2023 when I begin my payment. So you see the interest that we pay in 2023 is $4,759. The principal, so the actual money I'm taking off my mortgage is called the principal. So principal is the exact money you're paying against the loan. Interest, you don't pay that against the loan at all. The money does not come off the loan. That goes straight to the bank or the lending institution that you're getting the money from. So it means in November and December, I will have paid $1,233 in principal payments off my mortgage, but my interest is way higher. It's $4,759. So the balance of that, as you can see, is $448,766. So I didn't even take that much off in 2 months, which is totally standard. So this line here, interest, is going to be this blue one. So amortized loan, which is basically all mortgages across Canada. This is over 25 years. I pay way more interest at the beginning of the loan, and then towards the end of the loan, I pay very, very little interest. The principal, I pay very, very little principal. It's actually paid down the actual loan at the beginning, and I pay way more towards the end. And this is obvious because, we're going to be getting probably like a 5-year fixed term. So we'll talk about terms. What is a fixed term? Okay, so generally, the average mortgage you will get is a 25-year amortized mortgage over a 5-year fixed term. That means you can lock in a certain interest rate. 6.35% is the one we picked. 6.35% is our interest rate. That's going to be locked in for 5 years. That's not going to change. It's not going to go up. It's not going to go down. No matter what happens to the economy, no matter what happens to the Bank of Canada, that will not change over 5 years if you don't want it to. Okay, so you'll be locked into that rate. So that's why it was such a good time in 2020 when things changed and COVID happened. They dropped the interest rates very, very low, okay, down to 0.25%. It's almost free money. And so you basically didn't have to, there wasn't a whole lot of payments. It was very, very low. So you could lock that in for 5 years. So that's part of the reason why everything went so crazy, because people got these incredibly low interest rates. So they weren't paying that much per month on their payment. Therefore, they could afford a lot more. So that brings me to my next point. So how do interest rates really affect why the price is going up or down based on interest rates? This is your monthly payments. What I want to focus on. Interest rates affect prices by you paying more or less on your total mortgage payment. So I talked about principal and interest. Those together is your total mortgage payment. So for this property that we bought for $500,000, we paid $50,000 down. Our monthly mortgage payment is going to be $3,000, roughly $2,996.39. That's going to be our monthly mortgage rate. So people in general live their lives more or less kind of on a monthly budget. People get paid in general from a general job about every 2 weeks. So typically you make monthly budgets. How much can I afford per month to live? If you're renting a house, you don't pay per day. You don't really pay per week. You pay per month. You don't pay per year, right? Or you pay per month. So everything kind of generally is worked out that how much can I afford per month in my lifestyle? Because I know I'm getting paid twice in a month, so once every 2 weeks. So this is how I can kind of balance out my living. So can I afford $3,000 a month? That's kind of basically how our prices go up. So if the interest rate goes a lot lower than 6.35, you'll still be able to afford this amount of money. So let me just show you real quick here. Let's say this is in the middle of the pandemic and you got something for 2.35%. This is the exact same house. All I did was change the interest rate, and all of a sudden it's $1,000 less per month. So this is why house prices rose in value, is because people look at their monthly payment. Okay, I'm able to afford $3,000 a month. So in November 2023, that gets me a house for $500,000, considering I have $50,000 down payment. However, if the interest rate was this low, I would be able to afford, it'd be like $1,000 less. So I'd be able to afford more money. Okay, so that was $500,000. So let's change this now. Let's see if we put this at $750,000, and let's say our down payment was still $50,000. Okay, and I had to calculate my loan. What is that? That is very, very close to the same house that was $500,000, and it's almost the same price per month. So why did everything go up in value? Why did these prices go crazy? Because people were still able to afford about $3,000 per month. The price gets jacked up because more competition. Everyone wants to kind of jump in on these low interest rates because it keeps their monthly payments still quite low. You can't afford that per month. And so that's where we are right now. We're at this weird kind of bubble where the interest rate hasn't moved much in the last 2 months. It's still at 5%, which is the Bank of Canada rate. You can't get a mortgage for that. Your banks will charge more for that, or whatever lender you have. So typically maybe 5.9 to 6 point something, depending on credit, depending on your income, depending on your job, depending on job stability, maybe some assets in there that the bank will look at too. All those factors come in. Like, you need to discuss this with a mortgage broker. We are real estate professionals. We analyze all this sort of stuff. We negotiate on your behalf. We look at market data, but we're not financial experts. So please discuss all this with a mortgage broker. But this gives you some insight on how interest rates affect the real estate market, affect prices of everything. Anyway, again, I am Connor Mangan. I'm a realtor in Toronto. If you're looking to move here, if you already live here and you're looking to buy a property, if you found this video interesting, please give me a like and subscribe. All your real estate needs, please give me a call. I deal in condos and I deal in homes, and I work throughout the city, and I work every single day. So whatever it is, keep an eye on that interest rate, because it will affect things. I will also do another video on variable rates versus fixed rates, and maybe different terms on amortization, 25-year term or 30-year term. They all make differences too, but I don't want to confuse things too much. So adios, everybody. Talk to you soon.